these inventories have gotten pretty seriously low. I think that, we could have maybe 12 months, maybe 18 left in that. The argument from there tends to be, well, there's a lot of private silver that's held, private hoards of silver, especially in the East, in Asia, for example. And so, my counter to that is, yes, there are probably several billion ounces at least of silver that's held privately. And that, the argument is that this silver will come to market if if the deficits persist. I think that they will come to market, but at much higher prices. They will come to market not at $35 or at $40, but at $45 or $50 or $60 or $70. That's when those people will be willing to sell their silver back into the market and help to meet these deficits.
The silver market appears poised for further gains, though a short-term pullback may be necessary before the longer-term uptrend can continue. According to silver stock investor and expert Peter Krauth, a significant amount of silver is still held privately, particularly in Asia. While it's believed that several billion ounces exist in these private holdings, this supply is unlikely to re-enter the market unless prices climb significantly, likely into the $45 to $70 per ounce range. Investors holding such silver are expected to wait for substantially higher valuations before selling, which could further support a tightening supply outlook. Despite recent volatility, the broader silver market seems to be in a recovery phase. Some of the recent selling pressure in silver and gold may have been due to forced liquidations, particularly among hedge funds over-leveraged across multiple markets. As markets began to decline, these funds were likely forced to sell off their most profitable positions, such as precious metals, to meet margin calls. Silver, like gold, was a casualty of this scenario. Still, bullish momentum remains. Silver is on a path toward reclaiming the $35 per ounce level, although the move may be more gradual than some expect. While the price decline was sharp, the rebound may not be as aggressive in the short term. Krauth also points to the continued movement of silver into the Comex and private vaults in the New York area. These vaults, believed to be controlled by major banks and investment firms, are likely holding silver in anticipation of a future price surge. This behavior further reinforces the idea that institutional players expect a significant upside in the silver market and are positioning themselves accordingly. March has been particularly strong for silver, with more than 15,000 contracts delivered, surpassing recent historical norms for major delivery months. While new net contracts initially fell below the trend, they have since reversed course and are now exceeding monthly average levels. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
This explains where a lot of the silver from London has ended up. So, some people will say, is there a shortage in silver? So a couple of, thoughts around that. Technically, silver flowing from London to New York doesn't cause a shortage. It just changes where the silver is held. However, if you look at the next chart, then you'll see what is happening when it comes to the silver ending up in New York. So we see that very last bar all the way over on the right. March deliveries out of the Comex, silver deliveries, are the second highest in Comex history. And so what it means is that not only is the silver flowing to New York from London, but participants are taking delivery. They're requesting and getting their silver out of the Comex. This is very telling. I think that what happens is you've probably got, in both, my view is that you probably have industrial users and some sort of institutional financial participants saying, we are not going to leave this on the exchange even if we have our futures contract with a claim for it. The industrial users are taking delivery because they need it and don't want to have to pay tariffs, or didn't want to have to pay potential tariffs on it. And then the financial participants are saying, we want to have our hands on the physical silver, ahead of any potential run up, I think, in the price. And so this, again, I think is very telling, that to see these huge amounts of deliveries. I mean, I've heard anecdotally that there's a lot of, in addition to this, that a lot of the silver that has flowed into New York has gone into the Comex. A lot of it has also just gone straight to private vaults in the New York area, just sort of sitting there, probably owned by some of the investment banks and so on, bullion banks, and, just basically sitting on a position and being ready in case that, you get this potential large move up in the silver price. So if you could, we can talk a little bit about what I mentioned earlier in some of the fundamentals in the next chart. So I was talking about silver deficits. So these 5 red bars all the way on the right are including this year. So this last year is an estimate, and that is 149 million ounces. I think that's what the Silver Institute is expecting that we're going to see this year in terms of a shortage. I think it's actually going to be closer to what we had last year, around 180 million ounces. But the point is that if you take the average of these last 5 years, pretty significant structural deficits, you're somewhere around 200 million ounces per year. And if you add these 5 years together, that's an entire year's supply of silver when you combine mining and recycling. So about a billion ounces. So we're in deficit of a billion ounces across the last 5 years. That is really quite something. And the fact that, the silver price has not exploded in this kind of environment tells me that, yes, those consumers of the silver have, again, that to me explains what we saw in that earlier chart from London. And the charts for the Comex and for Shanghai are similar in terms of drawdown of silver the last 4 years. So I think that is clearly tells us that's what has met these deficits, but that can only go on for so long. These inventories have gotten pretty seriously low. I think that, we could have maybe 12 months, maybe 18 left in that. The argument from there tends to be, well, there's a lot of private silver that's held, private hoards of silver, especially in the East in Asia, for example. And so, my counter to that is, yes, there are probably several billion ounces at least of silver that's held privately. And that, the argument is that this silver will come to market if if the deficits persist. I think that they will come to market, but at much higher prices. They will come to market not at $35 or at $40, but at $45 or $50 or $60 or $70. That's when those people will be willing to sell their silver back into the market and help to meet these deficits. And at that point, that's that, so to speak, self-fulfilling prophecy where you've gotten that's helped to push these silver prices higher.
Peter Krauth notes that global silver production has been declining since peaking in 2016, now hovering around 800 to 820 million ounces annually. Despite steady demand of approximately 1.2 billion ounces annually, supply growth remains limited. This ongoing shortfall is bridged primarily through recycling and the gradual drawdown of above-ground inventories. In contrast to the broader trend of stagnating production, Aya Gold and Silver Incorporated has reported a strong start to 2025. The company announced silver production of 1.07 million ounces in the first quarter from its Zgounder silver mine in Morocco. This marks a significant 192% increase compared to the 366,362 ounces produced during the same period in 2024. The surge in output was supported by a 207% rise in tons processed, reaching 249,743 tons in Q1 2025, along with a solid silver recovery rate of 82%. Let's get back to the interview.
When we get the next recession, we're going to have stimulus again. And if you look back at the two last, large economic events that caused big stimulus globally, in fact, you had the financial crisis of 0809, and then you had COVID. In both instances, governments came around and very quickly decided to print a lot of money and have these stimulus programs. And they involved, for the most part, infrastructure, and they involved the transition to a greener economy. Well, the reason for that, I believe, is that because they're relatively easy sells. Right? You're not going to have much pushback if you say we're going to spend X tens or billions or hundreds of billions of dollars on these, green transition programs and or on infrastructure, because most people will say, well, I get to benefit from that. And so I can accept that you're going to spend that kind of money on these kinds of programs. We saw that happen both times. We saw that happen in the financial crisis. We saw it again in COVID. And I think that points to that bump in 2022 for silver consumption or for the deficit, because that's when that money started to really kick in and we saw a big spend on solar in particular. So that speaks to what I was saying earlier, is that, we've got, it was S&P Global Intelligence. I saw their research a few months back, and they were saying that if you look at the output from primary silver mines, because about 25% of mined silver comes from primary silver mines, and the other 75% comes as a byproduct of mining other metals like copper, gold, lead, or zinc. And so they were talking about primary silver mines, and they said that they saw all the way out to 2027 that the silver output from those mines would actually continue to drop. This chart in particular is silver, mined silver overall, both from primary and from byproduct silver mines. And what we see is that the output peaked actually in 2016. And it's dropped off considerably, and it's been bouncing a little bit lately, but we're somewhere around the 820 million ounce level. And the outlook is that this is not going to change very much at all, and that the demand is going to stay somewhere around the 120 billion ounce level. So to be clear, some of the supply comes from recycling. It represents about 15% of the annual supply of silver, but then the rest of it is coming from these above ground existing inventories, because as I say, we're consuming 1.2 billion ounces, but we're only producing 1 billion ounces a year. So I think the big move that we saw last year in silver, when in February it was trading around $22, and then it ran up basically to like $34, $35. I think it was in October. I think that was the market coming to terms finally with the fact that we are facing these ongoing structural deficits in the silver market, and that the inventories are only going to last so long. Mine supply is not keeping up with it. These private hoards of silver would and will eventually come to supply the market, but they will only do that at much higher prices. And that's what I think the market is sniffing out.
The silver market continues to show strength, supported by long-term supply deficits, growing industrial demand, and strategic accumulation by institutional and private holders. While short-term fluctuations are expected, the broader trend suggests tightening inventories and the potential for higher prices ahead. The supply pressure could intensify as mine production cannot keep pace, and above-ground stockpiles are gradually depleted. Silver may play an increasingly critical role in investment and industrial applications as global economic conditions evolve and stimulus efforts return. What are your thoughts on how these supply and demand dynamics will shape silver's future price trajectory? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.